The US dollar has again been buffeted by several emerging themes this month, most notably the results of the 2020 presidential election and, as we record, positive news from the Pfizer vaccine trial. Nonetheless, the US dollar has held to a tight range between 92.5 and 94 on a DXY basis, and is currently towards the lower end of this range. This is quite an intriguing result when you consider the disproportionate rise in new COVID-19 cases in Europe over the past month. Absent action, this materially increases the downside risk for Europe versus the US, and hence is consistent with a stronger US dollar. This has not been the case, however, and we believe it won't be going forward, with Euro and the UK's pound forecast to rise by 6% against the US dollar by mid-2022. Why is this so? To our mind, the main points to focus on for FX markets are virus containment and the economic policy mix in each jurisdiction. Very clearly, there is a material economic cost to introducing lockdowns. We expect Euro area and UK GDP will contract by 7 and 9% in the December quarter, wiping out most of the September quarter rebound. But these measures have proven effective in containing the virus. FX markets are forward-looking and so see hope that this second wave can also quickly be brought under control, allowing these economies to reopen. The successful initial results from the Pfizer trial overnight and the consequent market response also speak to this anticipation. While an effective vaccine will help all who receive it, arguably it will be easier to implement and get results in nations where the virus is already relatively under control, allowing authorities to act quickly in a coordinated manner to distribute the vaccine. This seems more likely in Europe and the UK than the US, who hasn't been able to stop the first wave of the pandemic. The other primary factor we need to consider is the makeup of economic stimulus. The Euro area's ECB has already expanded their balance sheet considerably more than the US FOMC relative to the size of their economy. They've also made clear their intent to increase asset purchases again come December. This is known and priced, as is the considerable fiscal support coming to Europe in 2021. This should allow a progressive transition from monetary to fiscal support in the Euro area in 2021. In contrast, if, as we expect, the US Congress remains divided for the coming term, the FOMC will remain the primary support for the economy for the foreseeable future, as partisanship limits the scope for new fiscal stimulus. At their meeting last week, the US FOMC made clear that fiscal support was essential and that risks and uncertainties surrounding the outlook are great. This is on top of an already weak baseline view with respect to the labour market and inflation, which is expected to remain below target to 2023. The scene is therefore set for the FOMC to also ease policy further at their December meeting through expanded asset purchases, and to flag further action as necessary in 2021. It goes without saying that these relative policy and virus developments are not only affecting the valuation of the US dollar against the euro and sterling, but also more broadly. The Australian dollar and China's renminbi will also receive support from markets from these factors, as well as our relative outperformance against the US in containing the virus and reopening sustainably. While a consequence of economic gains, the potential impact of currency appreciation on financial conditions will have to be carefully assessed by authorities in nations as diverse as Australia and China, else another headwind to recovery come into force. We'll see you next week.